welcome to Money Matters. I'm Emily Johnson, Certified Financial Planner and Managing Director of Polaris Capital Advisors. I am joined as always by David Kroll of Mortgage Network, and we are here to discuss all things where money matters to you in your pocketbook. So this week we wanted to focus back on a couple of themes that we haven't discussed for the last several weeks, really involving economic conditions and other factors that are impacting the markets. If you've been watching the markets for the last week or so, you've really seen just sort of steady, continued growth. We've had a couple ups and downs, but really for the last few weeks, we've just seen a very balanced market where volatility continues to decline throughout the day and throughout the week, regardless of whether we have a 200-point up day or a 20-point up day or a 100-point down day. The volatility is still pretty low. So that's sort of a good sign, I guess, if you will, although you could also say it's a harbinger for more volatility, which is what a lot of analysts are saying. But right now, if you have a 401k or investment accounts, you've probably been watching them just sort of slow and steady, kind of the turtle in the race, if you will. Mm-hmm. We're getting into earnings season, however. It's always earnings season. As soon as we finish one earnings season, there's another earnings season, but we're going to be hearing first quarter results announced in the next couple of days. And going forward for the next few weeks. And that's really interesting. It's not so much the earnings reports that are interesting as much as the forward guidance for the next couple of quarters. And that will be really interesting, especially when we've heard it's more and more likely that the Fed will raise rates at some point, whether it be June or September. That's good for companies in a lot of ways because it gives them a lot of visibility as to what their balance sheets are going to look like. However, if that does happen and the companies are looking at a lot of debt perhaps that could be revolving, then it could be negative for those companies. So it will be interesting to see what kind of guidance we have going forward with a lot of the analyst reports and earnings reports that come out. It'll also be interesting to see if we can maintain this low level of volatility going forward, or if that will start to spike. And that, of course, does create opportunities as well. So none of this is designed to say run and hide. What it's designed to do is say, make sure that you're watching your portfolios carefully and taking advantage when we do actually have those more volatile days, because typically that's going to involve some more opportunities for buying. So that's kind of what's gone on market-wise. So there's our first theme, of course, volatility, which we've discussed over and over and over again. There's several other themes. I don't know if you want to jump in with interest rate themes and a strong dollar. Or
tapping right directly off of what Emily just said, the world is poised to throw hand grenades into that less volatile state of affairs. And none of these things are very easily explained, and none of them are very easily put together or interrelated. The experts don't know quite how to put them all together into one forecast at the moment. The market is very difficult to forecast at this time. I think you would agree.
Oh, yes.
Across the sea, in Europe, the stock market, the FTSE, and the stock markets in Europe have hit an all-time high. They have been going up astronomically. They're up 17% in the last 60 days.
All because of QE.
Because of QE.
Speculatively, all because of QE.
And QE being what we've just done for the last 4 years, which arguably are what has caused our stock market to incrementally do well over the same period of time. QE, remember, this is sort of going over ground that we've tilled before, but it's good because it's complicated stuff. You remember that quantitative easing, QE, is the role of the central bank in creating more money to stimulate the economy. So,
creating more money, interest rates decline. In theory, then people will be spending more because there's not as much motivation to save money in your savings accounts, et cetera.
Exactly, and it's like putting it's giving a shot of steroids to an economy when you inject $50 billion, $100 billion, $500 billion into the economy. It is exactly like a dose of amphetamine into the economy. And it doesn't last forever, but it certainly gives a burst of activity. That's happening in Europe. European stock markets at an all-time high.
We're flat.
We're
flat.
We're flat, but we're at an all-time high flat. So, we're as high as we've ever been, but not moving. They're bounding up. But the bond market, the flip side of things, which is I think the sort of thermometer, remember when you were a kid and your mother put the thermometer gently in your mouth. The real thermometer of the economy, to me, is the bond market, because that's what I'm closest to. That's the core yields on government debt remains at zero, essentially, and we don't see it moving really very fast from there. The Fed wants, like the Dickens, to get off the juice, wants to raise interest rates a little bit, and then a little bit more, and then a little bit more, to regain some sort of
arrows in their quiver.
Yeah, basically to put themselves back in the game. And they want desperately to be able to do this. But contrary to it is the fact that the more quantitative easing that goes on in other economies, the less attractive their debt is. In other words, the lower priced their debt is, which makes our debt advantageous to holders of capital everywhere in the world.
So we started to discuss this actually a little bit last week. So basically what that means is we have these counter forces, one being the desire to keep interest rates, the desire to perhaps start raising interest rates as our economy is improving, but the other is going to be the strong dollar, because as we get more dollars into our treasuries, that increases the strength of the United States dollar. That actually can be a negative for our economy in general, but it's not something that can be avoided if we're continuing to increase interest rates, which is what is predicted. So, sort of the tail that's wagging the dog at this point, because there's the expectation, because the United States is several years ahead of Europe in their quantitative easing, in their rebounding out of the muck that we were in. Because of that expectation, more dollars have flowed in over the last few years, and now because of what is happening in Europe, which is positive for their markets but not so positive for their bond markets, money's flowing here again, and the dollar's continuing to increase.
It's a double triple whammy. Their debt's cheaper, ours is worth more, therefore money comes to us.
Which almost makes the Fed even less,
and makes
less potent.
Less potent. If they raise interest rates, that makes us more attractive as well. Everything is accruing to making the dollar stronger and stronger and
keeping
stronger
our interest
and
rates
stronger,
lower
and keeping our interest rates lower and lower. The dollar is extraordinarily strong right now. All of our major corporations, this is now the tail wagging the dog, our major corporations, our Fortune 500 corporations, are multinational corporations. They are not American companies. Alcoa is not an American company. GE is not an American company. You must cease to think that way. They are multinational companies. They're international citizens. They flow and they go wherever the business is, and the flowing and the going is good. And with a strong dollar, that doesn't make it easy to export goods from the United States. So that's going to be a drag on our economy. So it really is. I'm glad I'm not an economist. It's very, very confusing at the moment.
Yes.
We're predicting in the mortgage business, we're predicting that interest rates are going to remain consistently low in a trough for at least the balance of 2015. They may not remain at the super lows that they are right now. We're at 3 3/4 right now for 30-year fixed rate money, which is as low as we've ever been. But they'll be there or close to there for at least the rest of the year.
Which is a good harbinger actually for the rest of the market as well. I mean, most analysts are predicting slow and steady growth, which makes sense when you have continued low interest rates and a gradually improving economy, and you have other parts of the world that are starting to improve, which just sort of, by default will, create more opportunities for American companies as well.
Exactly.
So
it's all in all, it's very hard to be in Emily's business. It's very hard to be in the investment advisory business. I think this is where good investment advisors earn their stripes, because it's not clear what to do, and therefore the advising is very important. It becomes very personal as to who you are, what your objectives are, and so forth. And it's time. One of the I'm not trying to do an advertising gig for Emily, but it is absolutely the right thing to give your investment advisor a call and say, am I doing what I need to be doing?
Fantastic. Well, thank you for that.
Yeah.
Fantastic. And we will be back in just a minute with the second half, of Money Matters. We'll continue with some of these themes and how they're going to be impacting you and your portfolio. Please stick with us.